who has told no by a traditional lender. What our speaker is going to share today could completely change how you think about financing your next deal. Let's get right into it. So, it is my pleasure to introduce today's featured speaker. Anusha is a senior mortgage and DSCR specialist at Sistar Mortgage, a nationwide lender. Most mortgage professionals start in lending. Anusha didn't. She started on the trading floor as a senior interbank dealer in wholesale money markets and interest rate swaps. She has personally traded the bonds and interest rate derivatives that eventually become the mortgage rate on your loan. That journey from CBC, check before closing on the derivatives desk, to CTC, clear to close in mortgage lending, spans over 2 decades of financial expertise that very few people in this space can claim. What that means for her clients is simple. She doesn't just quote rates, she understands why rates move, how to time decisions, and how to structure financing around an investor's long term goals rather than just getting a deal across the finishing line. Today, Anusha specializes in DSCR loans, non QM lending, and complex mortgage scenarios for real estate investors, self employed borrowers, and business owners, including people who have been told no by multiple lenders. If the credit is reasonable, she believes there is almost always a mortgage solution. The difference, as she puts it is structuring the loan correctly, compliantly from the start. No sugarcoating, no fluff, just clear analysis and execution. Please welcome Anusha Sumugam. Anusha, the floor is yours.
Thank you. Hello, everyone. So I know most of you here, some of them are my clients, past clients, and also some of them are realtor partners with whom I work. Welcome and
Uh,
thank you very much for joining.
Sorry to interrupt you, Anusha. Your voice is a little bit echoing.
Okay. Is it okay now?
Little better.
Okay. Okay. So is it audible?
Yeah, now
Okay.
it's clear.
Okay. So let's start on the DSCR programs. So next 30, 35 minutes, whatever I present, it's nothing about the interest rate or where the markets are. It's all about this program, how it helps the investors. And it's not the end all product. It just works for some. It may not work for some. So let's begin. Okay. So DSCR product, why it has become so relevant these days. So the markets, the work environment has shifted, especially after COVID. So you wouldn't see many of them doing a 9 to 5 job. They've shifted, like, their incomes are messy and hourly jobs, self-employed. A lot of them work on the social media. So it's like everywhere. So that is the reason this program has gathered so much of popularity last 3 4 years, I would say. So these programs, like, because of their popularity, it's like not just for institutions, but for individuals too. So number two, so this is because of the work environment that has changed over a period of time. Now, the other reason is because of the messier income and, like, this has always been there. This product has always been there, but the way things have changed, so no tax returns and a lot of investors and self-employed borrowers, they have, like, heavy write-offs, which is their strategy, which is fine. So these things doesn't matter in this program. So people have found this like valuable, especially the investors. And you see a huge market, like, 25% of the loans are in DSCR. The other advantage is, like, you can close in LLC, which you cannot do in conventional loan. Then the pricing is also as same as conventional today. If you see, the spreads are actually narrow. So all these things are, like, it's a gold, it's a treasure for a seasoned investor. Rather than, like, you're going to Bank of America or any wholesale lender who's into conventional, they dish out thousands of documents for tax returns and K1s and all that. Finally come back and they hear it's like, it's not possible. So there's a lot of surprises involved in that. So That's one of the reasons this program has become very popular. So it's kind of scaling smarter and making use of this program. It's not a loophole or last minute program. What is DSCR, like how it is calculated? So DSCR, it's not just related to real estate or something. It's for any kind of markets we use this term. So for the residential mortgages, it's typically the gross monthly rental divided by your monthly PITIA. What is that? That is principal, interest, tax, insurance, and HOA. So all that is what you pay every month for a property that you own, and the gross monthly rental divided by the PITIA. That's the simple most way to explain. And maybe like, for $1 you pay, what do you get in return? That is another way of understanding. Again, the formula. So the gross rent divided by the monthly PITIA. Now here, there are different ways of the layering it out on the ratios. Some properties may be just breaking even, where the gross rental can be 3,000 and PITIA, like principal, interest, tax, insurance, and HOA you pay is also 3,000. So in that case, it's just breaking even. Now, if you ask me, is it just breaking even for outside of the lender's purview? It may not. It may go negative because you have to consider the vacancy factor and all that stuff, the repairs, maintenance, and all that. As far as lending is concerned, it breaks even. Now, it can be positive cash flow from the lender's purview, because if it's like 4,000 is your rent, 3,200 is your PITIA, so it gives a positive. Negative cash flow, like there are a lot of scenarios where I see negative cash flow. Still, it can be done. So where it is like rental is lesser than your PITIA that you pay for the property. Okay, so this is a calculation I was explaining about the positive cash flow. So monthly rent is 4,000, PITIA is 3,200, DSCR is 1.25. What does that mean? What is 1.25? So you pay $1, you get 25% more. So 1.25 times of the amount that you pay every month is what you're going to get as rent. That's what it means. So the best case scenario for any residential property or even multi-units is 1.25. So this also, out of the mortgage's purview, this also considers your vacancy factor to a certain extent and maintenance, reparations, and all that stuff. Okay, so here is the comparison for between a DSCR and a conventional investment. So many people are in the second zone, that is conventional investment, which is fair enough. It's not like, DSCR is the product that works for everyone, me not. Now, when a borrower comes to me, he's buying his first home or a second home or even a third home. As far as he doesn't have any future plans of blocking his DTR for his primary home, then I would always go for conventional. Again, providing all the options and the borrowers can choose. Now, basic difference between DSCR and conventional investment is conventional, that it's always W-2 and tax returns and pay stubs and all that. DSCR is no income, so it doesn't mean no docs. A lot of times I get pushback from clients, hey, you said no income, but it is no income, personal income, but it has some documentation. Now, income docs, okay, so you don't need any personal income documentation. W-2s, tax returns, then your K1s if you have other businesses, pay stubs and all that. DTI ratio, of course, there's no concept of DTI here. So the ratio, DSCR ratio is the bedrock of this structure. Conventional, you can go up to the DTI factor comes in, so 43 to 50%. Some lenders I have can do up to 60% also. So that is about the DTI. Maximum properties. Now here is the catch. Now here in conventional, limited to 10 properties. You cannot go beyond 10 properties if you want a conventional loan. This is the treasure for all the borrowers, the seasoned investors. Unlimited. You can scale it unlimited. There's no limit of 10 properties or some have 8 properties, nothing like that. LLC ownership, this again, seasoned investors know the value of this. It protects liability protection and all that stuff. Like a borrower who has a property, 1 or 2 property, they may not even need all this, but still this protects you. You can close in LLC up to 4 members. Most of the lenders offer up to 4 members. This conventional cannot be closed in LLC at all. Maybe some people move it to LLC after post-closing, 2 or 3 months down the line, which is okay. Like as far as the servicer or the lender is okay that, okay, the borrower is paying the monthly, they are fine. Just the title can be moved to LLC. Now, self-employed, of course, like, anyone who you don't even work, you can take a DSCR loan and buy a property. Write-offs, like, this comes as a surprise. People tell me, like, when I work with investors or self-employed with physicians, or they'll come and tell, okay, my income is like, 1 million. And you take all the returns and you see, like, it's hardly anything. So this plays a great role. This can be a game changer in conventional. So in those scenarios, like if the borrower is an investor, we move them to DSCR. If it's a primary home, there are other products which we can do it, where again, tax returns are not considered. Okay, this is something like which is very crucial for all the short-term rental investors. The conventional loans, we cannot close any Airbnbs in conventional loan. Fannie Mae and Freddie Mac doesn't allow. So this is the product where we can close it. The way of calculation of the gross rental and everything is different here with some haircuts. I can explain you that later. Rate environment. Now, a lot of people say that, oh, DSCR, they just don't even want to hear it. They say, look, DSCR has a higher rate. Yes, it was. If you see 2-3 years back, it was like, if conventional was around 6 or 6.5, the spread usually would be higher by 1%. So if it's 6, it would be 7. Now it's not the case. In fact, some of the DSCR, if the top-notch score with ratio of 1.25, you can see as far with conventional, or even sometimes a quarter or a 1/8 point better than conventional. Prepayment penalty. Prepayment penalty is something which is always there in DSCR. So it's a structure. So a lot of people come and tell me, like, hey, this lender is not offering me prepayment penalty. Why are you offering? They just don't transparently explain the borrowers that it is their choice. They have the power to choose the prepayment penalty based on their exit strategy. So it's all, the marketing gimmicks, but prepayment is always there. If it is zero prepayment, it will always be loaded into the rate, which sometimes borrower may not even know, or in fact, not educated about. So conventional never has any prepayment. Lender DSCR versus true investor. I mentioned this about it in the start. So when you qualify a property and a borrower in a DSCR, a lender's focus is just on, okay, the gross rental is 4,000, you're paying for 3,200, okay, you're qualified, borrower is also qualified, so there it is. Now, out of this lender purview, as far as the investor is concerned, their way of looking at it, or they may ignore it also sometimes, is the property management, repairs, utilities, capex, vacancy, and regular maintenance. All this includes in your cost of the property that you pay, like every month you pay. So these things like maybe 0.25 or 0.5 in some properties. So as far as lender is concerned, they qualify you based on 1 or 1.25 negative cash flow. It doesn't mean that the property is good. Sometimes it may have more cost. So loan approval does not mean that the investment is strong. It means that. Okay. So the borrower profile and qualification, like who uses these DSCR lending? Seasoned investors, of course, because the advantage of, they can keep on scaling. There's no stopping. There's no looking beyond, like, just wait for these DTI or limited number of properties. They can have 50, 100 properties, just keep buying. That's the advantage for the seasoned investors. Tax smart investor, like I said, to like, people who are like self-employed business owners, their taxes are messy and they don't want to get into all these things. Some people don't even want to reveal the taxes, which is fair enough. In those cases, this is the best product. LLC investor, of course. So people who want to buy properties in LLC, they would always prefer this and not under their personal name. There's something more to it, which I'll explain later. Short-term rental investor, as I told you, conventional does not cover short-term rental. We cannot close. So by default, this is the product. Then PRRR investors, capital recycling. So typically like fix and flip borrowers who take loans and bridge loans, hold it for 6 or 12 months and then stabilize the rent, convert it into DSCR. So these are mostly these are the people who prefer using DSCR. Use cases for DSCR, of course, any purchase transaction is covered, rate and term refinances, like any conventional loan, cash out, that we do in conventional as well. Delayed financing, which is done in both the programs, but the advantages are some of the lenders may not need 6 months of seasoning. They are just fine with 1 month or 2 months or no seasoning also. It all depends on lenders. There are hundreds of lenders and hundreds of guidelines. Every lender will have tens of guidelines, and we have to fix any scenario like a puzzle with every lender. Debt consolidation, of course, we do that in conventional as well. Portfolio growth and capital recycling, of course, for fix and flip borrowers. This is the best. They just get the stabilized rent and they just get going by flipping it into a 30-year or a interest-only loans, which is 30-year amortization, those kind of loans. Property types, single families are always covered. We can do any loans for single family rentals. Then multi-unit properties. So multi-units, some of the lenders, they are restricted to 4 units and some can go up to 8, some can go up to 10. I haven't seen more than that, then it becomes a commercial loan. So for DSCR residential program, 8 or 10 multi-unit properties can be done. 8 to 10 units of property. Condominiums, yes, now the warrantable and non-warrantable, both can be done under DSCR. Then the zoning part. Now, when we do a lot of these Airbnb properties, many fall in rural zoning, which even the borrowers may not know. So these kind of rural zonings cannot be done in a lot of programs. But DSCR, some of the lenders allow it. And in fact, now many of the lenders have started allowing rural zoning. Then, okay, so this is another popular one these days, assisted living in a residential unit. So this is another program which is like popular these days, which is closed under DSCR. LTV trap. Now, why it's a trap? So now a borrower calls and asks me, hey, can I get a 20% down payment and 80% LTV loan? Okay, I can say that if he qualifies in the conventional loan with his income off the bat. In DSCR, what happens is it's very difficult to say, okay, I can do a loan with 20% down. If a lender tells that, it's definitely a trap and the borrower will end up seeing a lot of surprises later. The reason being, everything revolves around the appraisal value of the property, okay? Appraisal value and the rental value of the property and the way the property is. That is also a very important and crucial thing to decide this LTV. So why it becomes a trap is a borrower has in mind that, okay, with the 20%, maybe I can end up buying a property. He should have reserves. He should have extra cash, funds to even get that. What if the property is in a declining market? So the lenders would say, hey, you bring 5% more. So instead of 80, it can become 75%. Now, if the borrower gets into contract, they have the 10 days of contingency and the appraisal doesn't come back. It comes back later. They have no choice, but they get into this and it gets messier. So off the bat, we cannot say, okay, we can do it at 80 or 75. It all depends on the appraisal and always have to have both the spectrum, like the worst case scenario and the best case scenario as far as LTV is concerned. So that you have you are equipped and you know that when you put an offer, you know what to do and you're you have your reserves and cash all set up. Okay, again, reserves and liquidity. Now, all these DSCR programs, even conventional for that matter, they always need reserves, okay? Without reserves, no DSCR programs are done. So it's because of the risk factor, because we are not using any income of the borrower. So it's basically the cash flow. After closing, the lender wants to ensure that is his loan at least covered for 3 months or 6 months or 12 months based on the risk factor, a risk scenario of that borrower's profile and the property profile. That is the reason by default, you need 3 to 6 months of reserves. How the reserves are calculated is a property, you're paying say $3,000 a month as a PIPIA. So 3,000 into 3, 3,000 into 6, or depending on the risk profile, it can be 12 too. So most standard is 3 to 6 months of reserves that borrower has to keep in mind. So the lender wants to ensure that all these vacancy factors, repairs, maintenance, everything is covered. Okay. Prepayment penalty, as I mentioned before, DSCR programs will always have prepayment penalties. Now, when the borrowers come in, when we have initial conversation, they would say, hey, some are offering me no prepayment and some are giving me 5, and I'm okay with 5 because I get a lower interest rate. Now, what happens is, okay, you're happy with the rate of interest. For example, for a discussion, say for a 5-year prepayment penalty, the borrower is not being explained properly, and he says, okay, I'm getting a 6.25 and 0 or a 2-year or a 3-year prepayment. Maybe I'm offering, say, a 6.5. That 0.25 is the decider for the borrower who's short-sighted because he's not seeing beyond that transaction. What happens after that is, life happens. We don't know what happens to the property, what happens to the borrower scenario also. Anything can happen to the borrower or the property. They'll end up refinancing it, or they may have to sell it also. Always work around the exit strategy. So when I talk to the borrower, first thing I ask, the rate and all is later. What is your strategy behind this property? Are you going to hold it? Or are you going to dispose, just refinance it, cashing out later? Or maybe he wants to put it in LLC also. So that time, it is a refinance. So anything you do a refinance, you have to pay prepayment penalty. So a borrower cannot take a loan saying, okay, I'm happy with 6 quarter, I'll go with that. And later on, after a year, something happens and he's ending up refinancing. It will bite you back hard because these prepayment penalties are 3% of the loan amount. Say suppose a 300K loan, you have to pay $9,000. So every year it changes. If you go for a 5-year, fourth year if you do, the first year itself you do, it's going to be 5%. It's $300K, $15,000. So you see the difference and see what is better, getting that quarter and just having peace of mind, or going for that 5-year prepayment. So this is very crucial in any DSCR program. So when you work with the lender, first thing is you have to ask, what are the options available, the best and the worst case scenario. What kills a DSCR loan? Now, main thing is the leverage. As I mentioned, the LTV, that people come with the hope that, okay, 80% is possible or 75 is possible. Always you need to have a cushion because everything depends on the appraiser. Then the deal works on a spreadsheet. This also explained you before, the mortgage purview is okay, the lender is happy with one ratio, but out of the mortgage purview, does it really work? That is something a borrower or an investor has to do the due diligence. Investor focus on rate, of course, DSCR is not a cookie cutter program whatsoever. A lot of people sell rates, they quote a rate and they get the deal and they mess up. It is not at all a cookie cutter program. The reason being, this program, I would say, it has almost 10 to 11 levels. The ratios. If the ratios change, rate changes. We don't know till the appraisals are back. And then LTV. If LTV changes, again, rates will change. If the property is in a declining market, it is in a declining county. For example, there are counties in North Carolina and Arizona also. I've seen declining counties. The properties come as a declining county, then 5% share off in your LTV. So these are the levels like push and pull. The entire structure can change. So that's why any lender who quotes you, hey, I can offer you this, I can quote, never it happens. It always comes with a surprise. If nothing changes, hunky-dory, best scenario, the rates remain the same. Otherwise, they always change. So always keep a margin of maybe a 0.25 to 0.375 for the surprises. Now, more levels are the investor experience. What if a lender takes the file and finds out that he doesn't have a primary home at all? So he becomes a first-time investor or a first-time home buyer himself. So the entire structure changes. Instead of 80%, he can only put 70% or 75% if he doesn't have a primary home. So all these factors change. Then vacancy. If the property is vacant or there is no lease, things can change. There are lenders who are fine with no vacancy as well. But if a broker is working on your file and then they find out that the property is vacant, there are lenders who will not allow. They will say you can only get 65 or a 60% loan to value. So these things are constantly changing, and we have to ask these questions upfront with the borrowers. And borrowers also, the investors also have to be very honest so that we can find the workarounds, because there are plenty of lenders. We can always find a workaround and to keep the deal alive. Okay? Exit strategy, again, things change. If exit strategy, I change it from 0 prepayment to a 5-year prepayment, things can change. Then long-term and short-term. As I always mentioned, this is one of the crucial levers. Short-term rental, the pricing, the way we calculate the ratio is entirely different than what we do for a single-family long-term rental. And also, in a short-term rental, another key factor which many people miss is how the property is managed. Now, when you take an Airbnb, some people, they manage it by themselves. Some will have, they'll have their property managers. That is a cost. Then the cleaning expenses, that is another cost. I had one scenario where this was found out very later. An Airbnb property, it seems there was no water in that. The well was empty, and the appraiser found out, and that was the last minute. And he had to get tanker every week for that Airbnb property. Property is extremely beautiful property, but no water. So every week he has to get 1 or 2 tankers. That is a cost. Now, that cost put together, it changes the whole scenario. So there is no way we can quote a rate or, hey, this is what I can offer. We offer the best and the worst case scenario, and we settle somewhere in between. So these are the levers that can really kill a deal. Okay. Common myths. Okay, so as I told you, I mentioned this before also, DSCR rates are higher than conventional. No, because of the popularity of the size of the program, the rates are almost at par or even better. Why it is better? Because there is a secondary market to it. It's not just you're closing a loan and it ends. These loans are bundled, and there are investors in the secondary market. So in the secondary market, they see the size and volumes happening, interest being generated. They will buy these bundled loans for a premium. That is the reason the rates are at par now. So then, this is something very important. DSCR loans closed in an LLC. Now, borrowers will come and ask, hey, we are closing in LLC, so it's a non-recourse loan. No, it is not. It is a recourse loan. It is closed in LLC, but personal guarantors are always there. The owners of the LLC, about 25% ownership, they will be personal guarantors. Personal guarantors, meaning the lender can come behind you. If there is any default, they can take your personal assets and everything. So it's a recourse loan. Then 2 years of rental history to qualify. I hear this a lot of times, when they say 2 years or 1 year of rental history. It all depends. There is nothing you need that rental history. Sometimes we can get it done without the rental history also for a property. But again, it is always your rates could be compromised. There are ways to get it done. There are lenders who can do it. So even if there is no lease, if it's vacant, there are lenders who will still do a 75% LTV also. Next one would be, the STR loans. So this is something we always see every day with the Airbnb investors who do buy or refinance. It is Airbnb overlays are all over the place. Okay, there are tens of lenders. Every lender will have their own overlays. Some will be okay with rural. Some will be okay with 10% of management expenses shaving off from their income. Some will say 25, some will say 20. So really we have to take that scenario, put it in a place where that borrower is borrower and the property fits in properly. So the lender selection is very, very challenging for this one, short-term rentals. One loan, same terms. Okay, so this is day in and day out we see. I've also written a couple of articles on this, like in social media and all. So when borrowers come and tell me like, hey, what's the quote? What's the rate? It just doesn't work. As I again and again tell, it's not a cookie cutter program. For one property, for a borrower, I will quote you 10 rates. Because of all the levels, I push one, rate changes. I push the other one, rate will be different. So there is no just one rate. If the borrowers are getting that, I'm sure they will end up in surprises, in a costly surprise. So always ask right questions with the lender, whoever you work with. Ask these questions. Now you have this list. Always keep in mind and ask all right questions, and be open to hear the worst cases also. Okay, this again I mentioned before. You don't need any documents. No way, we need documents. It's only no income, no personal income documents. Okay, we always need. It's based on your primary home mortgage. So how does a borrower is how a borrower is qualified? A borrower is qualified with a credit score. Next comes is the ability to repay, which is called ATR in mortgage industry. How do you know the ability to repay? In conventional, we have the W2 tax returns or whatever. Here, there is nothing like that. So the ability to repay comes from your financial discipline, like for your mortgage, for your primary home. They'll ask the history. Or if you have the investment property, they'll ask you the history. Or if something like, the subject property itself, they may ask you the history of like 12 months. So be prepared for that. So it's not a no-doc program. What scenarios I can do? Okay, so many scenarios, like first-time home buyers. Any first-time home buyers can be done. Like they don't have investment properties, they don't have say their primary home also. They are rented. They live in a rented house. Still, we can still do that scenario.
Apologies for the interruption. Our audience is getting an echo from your mic. Can you please check?
Oh, is it good now or no?
Yes, it's good.
Good.
Yeah.
Okay. 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 Next is foreign nationals. Any foreign national, we can do the DSCR. They are investors, and they have their bank account in US. No score, no credit history needed for them. It's just like if they are in, say for example, if they are in a different country, the credit score, their history. That is all you need, and a bank account here. And of course, the assets have to be strong. Airbnbs, as I explained you, it is possible. There's something called PAT split, which many people don't know, even many of the lenders don't know. That is like, in one residential unit, there are multiple rooms that are rented out. So that is PAT split, which is very popular. That is one program which can be done in DSCR. Assisted living, you bring it, I can do it in a residential home. Then comes is a borrower who has, say, a 620 score. And you know how compromised the rate, the loan to value, everything is compromised for a borrower who has a 620 score. Now, is it possible to get a better term? Yes, 100%. So when he brings another investor who has, say, 760 score, and he's also an investor, so entire scenario changes in his favor, because the rates will be different, the terms and conditions will be different, the reserves that you need will be different. You don't need 12 months, you may need only 3 months. And loan to value mainly. It can be like, if a 620 borrower can get a 65 or 70, you can go up to 75, 80 easily with another added borrower who has a strong credit history. So we can take the higher score. Long-term rental, you bring in without any lease, doable. Then if the appraisal comes, say, lower, the rental value appraisal comes lower, but the investor is getting higher rent. So we can still, some of the lenders can take the higher rent if we show 2 months or 3 months of rental receipts. So that way he gets the benefit of that actual rent that they receive. Cash. So another thing is delayed financing I mentioned before. It's a cash purchase, say I buy it today. I bought it by cash and I want to get the funds back so that I can put it somewhere else. That's called a delayed financing. No seasoning needed. You buy it on cash, you can immediately do a cash out refinance on that without any seasoning, and you can do it up to 80%. Seasoning is seasoning on the title. Okay, another scenario is like a spouse. A spouse is not working, and then the family is interested in investment, and also husband doesn't want to do because they want to do it, keep some GTI thing for their primary or whatever. They can always buy in wife's name, open an LLC. She can keep buying because she doesn't even have to work. Or a spouse, he doesn't have to work. It's just purely if you have assets, you can keep buying. There's another advantage is you can use gift, which no other programs allow. Investment programs, if it's a conventional, no gifts are allowed. In DSCR, you can bring 80-90% gift and get it done. Then for the down payment. Then any property, like if you do a refinance, like if the borrower lists them, he has already listed, say if it is in the market as a listing. A lot of lenders don't, conventional cannot do it. But DSCR, if you remove the listing, the next day we can always refinance it. So that is the advantage. Those kind of scenarios are always possible. Then seller concession. Now I see this with new builds. New builds, they give like 6% seller concession or 4% seller concession. A typical conventional loan will always need a 2%, okay? They cannot go beyond that. Here we can do 4%, 6%, up to 6% in DSCR. So that's a win-win for the borrowers to cover their closing cost and any other, like, prepaid HOAs and all that stuff. Then Airbnb, as I told you, the rural zoning are very common and a very popular product. Non-warrantable condos, anytime. Condo hotels, anytime. All these scenarios are doable easily. Another one last and very important thing is when there is a seller financing involved. So when there is, that's called a Morby method, where a seller will give, say, the borrower wants to put only 10%. Then what? If the seller is ready to give another 10% or 15%, that becomes a second lien, and the remaining of that 70% or 75% becomes the first lien from the lender. So that combination, we always do it when there is a seller financing. But zero down payment is not possible. So lender like always wants skin in the game. So they will always ask for a 10% minimum. So these are the common scenarios which we do. Now, this is all about me. So it's like been in the industry for like since 1998, dealing with interest rates. My perspective of looking every mortgage is so different than a typical rate quota, because at the end of the day, if you see a quarter bit or a 0.375 difference is really not going to impact. I always tell them to look from a dollar perspective. It's like $40, $70. You go out and have a dinner, it's done. So that's the way to look at it. Don't get pressured by the market changes and the noise, like, today the rates are high, tomorrow the rates are low. Then that concept just doesn't work. I'm like, I'll be calm. I know what is happening. I do follow the interest rates very, very closely. Been doing that since 98. Then multi-lender access. So the advantage of the brokers or people like me is we have like 100, 150 lenders. Somewhere we can fit the scenario, any scenario. We have to find it. We have to do the hard work. It's not easy when we do DSCR loan, because it's not, we are just quoting a rate and we are doing no. We have to wait for the appraisal. Things change. We put it with one lender, doesn't work, we have to pull it and find another lender and do it. So multi-lender access with any investor who wants to work with the lender, find somebody who has access to multiple lenders. So that gives them kind of a protection of closing the deal. Non-QM, DSCR is also a non-qualified mortgage. My core and my niche has been in this program, and I work on structures and bridge loans, fix and flip, private money also. So this space is like something I really work on and work for the self-employed borrowers. No bait and switch. I have lost a lot of clients because I cannot do that. It's just like, straight shooter. This is what it is, and it is in your favor. So whatever I quote, say if I quote some rate just before the lock, it will be ensured. It's no back and forth on all these things. It's very, very transparent way of working. Many people do not want to hear that, some kind of reality they don't want to hear. but that's fine. But ultimately, they go find out, they get stuck. It is always there. So that's how my work ethics are. And of course, like, I don't work on rates, just rates. It's a total solution. I'll try to find a workaround, if not DSCR, if not any other programs for that matter. Even in DSCR, if something doesn't work, I'll find a lender and make it happen. If it doesn't, I'll just be honest with it. The place where I work, Sistar Mortgage, is a nationwide lender. So any states, we can work it out and find a solution. So it's all about it. And I'm happy to take any questions. Thank you. Thank you for your patience and listening to it.
Thank you, Anusha. It was a great session. So, guys,
Wonderful.
if any, yeah. So, if any of you have any questions, you can drop it in the chat and I'll read it out. So, we got the first question from Mamta. He asked, if possible, to touch on affordable housing projects, can one get development loan to rehab a single family affordable housing project with DSCR?
Yeah, it is. It is possible. Again, it depends on the scenario, like, who's going to buy that, and is it an institution or an individual? So it's quite possible. If it's a rehab, like someone is buying it and doing a rehab, 100% possible. So there are so many lenders who would do that.
Thank you.
Okay. So, yeah, we got a question from Kalyan. Can this loan be applied for a commercial property, retail space?
See, it is. So that's where it is actually popular. When any commercial loans come, like, it's always the DSCR, the operating income of the project. DSCR is always doable in the commercial space. Where if I do it depending on the project. And I have other lenders where I work with them and get the deals closed. Yes, 100% DSCR loans are possible.
Okay. And we got a question from KM. For a DSCR loan on property, uh, 2, can we use the rental income on property 1? Both are commercial properties.
So this is more about residential, but commercial probably I didn't get that question. The rent can be used in what?
Yeah, for a DSCR loan on a property, let's say property B, can we use the rental income on property A? Both properties are commercial.
No. If it's a DSCR, it's only about that property, whether it is residential or commercial. So that is the income. So suppose it's as good as like asking, hey, it is my income. Can I use somebody else's income for me to qualify? In DSCR, it's only property, and that property has to generate cash flow.
Okay, okay. So I have few questions of mine also. Yeah, like we got one more. Are there any population limit for DSCR? Asked by Praveen.
Population limit meaning
So
something.
in the sense, if a city has X amount, take example of Sherman or Barnum, so which may have around less than 20,000 people, is there any restriction around that?
No, I haven't seen. So I've closed loans in Sherman and Bonham also. Bonham sometimes could be in Texas. We don't have the zoning issues also, so it's quite possible. So in Bonham, I've closed a lot of properties which has those. The acreage is higher, but there will be one small property in that, and it's quite possible. Not a problem at all.
Okay. So yeah, like I have one question. You came up through the bond trading and interest rate derivatives before moving into mortgage lending, right? So how does that background actually change how you advise clients on timing, rate locks, and deal structure?
Okay. So when you work with bond markets and you see the ebbs and flow of the moments for how many 28 years, that's been you read and see what happens in the long run. It just evens out. Like today with the inflation, see, inflation is the main factor in the macroeconomics, which people fail to understand. Today that 6 quarter of interest or whatever the dollar amount you're paying is not going to be the same when the inflation is higher later on, right? So that is something, just by quoting rate, it doesn't happen. These things, like we see this day in and day out, how it evens out. And one more thing is, when you invest on a property, and suppose the borrower cashes out and he tries to put that money somewhere else. You look at the bigger picture. The money is going to work somewhere else. It's not going to be just like locked in here. So the rate movement is just one factor in buying an investment property or even a primary home. So more to it is like, just about what is the impact. That is what I always tell the borrowers because of what I see, what I've been seeing in the bond markets and interest rate derivatives market.
Okay, great. So, like we got another question from Arun. For a 200,000 property, what could be down payment to get DSCR loans with 5-year exit strategy based on another property which has DSCR at 1.31?
Okay, so trying to understand. So this property has 1.31 as ratio.
Uh, the another property has 1.31 ratio.
Okay, so when we are doing a DSCR loan on a property, okay, property A, we only see what the property A gets, okay, cash flowing. If it's getting one ratio, for example, just the best, we leave the best case scenario, optimum, one ratio. For a 200K, say 80% LTV is 160. Possible? If any time the LTV is decided based on how supportive is the cash flow of the property. So we have to constantly tweak. Now I can commit, say 75%. Now, what if the rent doesn't support? Then we have to tweak the LTV. Maybe it can go from 75 to 80%, sorry, lower than that. So it all depends on how supportive the cash flow is.
Okay. I hope that answers your question, Arun. Um, yeah, we got another one from me only. Uh, yeah, so a lot of investors in our community, you can see own two, three, or maybe more properties and are financing them conventionally. At what point does it make strategic sense to start using DSCR actually?
Okay, that's a good question. So, um, okay, so what happened in 2020, 2021 was the rates were very low. Okay, so I've seen borrowers like good income, like if you say a 200K, 250K income, household income, they ended up like adding properties like seven, eight, nine properties in conventional. That would work 100% with that kind of income because the properties are cash flowing. Markets were
Mhm.
different, vibrant, and very active, and the rates were very low. So it was like twos and threes people could get. Now, if you ask me that rate, it will not. So it's going to be sixes and sevens. So what happens when you do conventional is at one point, with all the Schedule E, with all the property shown in Schedule E, they'll claim depreciation. They want that also. They want to pay less tax also. So in a conventional scenario, it slowly starts like impacting your DTI. So at that point, like these days, we see with 200 to 50K income, three properties, four properties, and then the DTI becomes an issue because they start claiming depreciation and other costs and all that in taxes impacts the DTI. So that is one scenario. That's when we like ask them to shift to conventional, sorry, DSCR. Another thing is like suppose if they have plans, like I always ask the borrowers, okay, you're doing a conventional when they are investing for investment investors. I ask them like, okay, do you have any plans to buy a primary home? Because that is something that you have to have space for in DTI. You cannot exhaust that. So if the buyer has that plan in a year or so, I don't want to block them there. I'll put them into that this DSCR program where the DTI is like saved for the primary home. This is another scenario, very common scenario. And of course, like when they want to protect the liability protection and all, they don't want to put in their personal name. Always DSCR. Like, see, these questions have to be asked to the borrower upfront. It's not like hey, okay, I got the scenario, okay, I'll do it. No, these questions borrower also has to ask and clarify and just make a prep list and ask like what is beneficial. Not all the time DSCR is beneficial. Some people are okay, good with conventional. It's all situational and scenario based.
Okay, so that brings to our next question. When an investor comes up to you about a DSCR loan, what are the right questions they should be asking? Like, what should they bring to that first conversation?
Yeah. So some of them I mentioned just before.
Yeah.
Then comes this like their exit strategy. What strategy? What is their strategy with that property? That will be helpful in
Can you please
structuring the
expand?
whole deal.
Can you please expand more on exit strategy? What do you mean? How does it matter? Financing? Thank you.
Yeah, it matters because see, I'll tell you one scenario. Borrower buys a property, like say, just they get enticed, say, for a rate. Okay, the lender also says, okay, oh, you got this deal at 6 quarter, for example. Then sometimes it is so not transparent to the borrowers, they don't even realize that they got into a prepayment penalty. Okay, when it hits bad is when they try to refinance or when they want to just get out of the property. Okay, that's where the exit strategy matters in any investment property. It's an overall structure preparing the borrower for not just for that property. You have to prepare them for the future investment also, right? So you can't end up paying like $15,000 or $10,000 as penalty just to get that quarter bill. It's not worth it, right? So that is something that always a borrower should ask. And another question borrower should ask is like, especially for this program, is they should ask for three types of spectrum. Like the worst case, what will happen if the rents are coming low? What will happen if the appraisal comes low? What does the structure look like? Next is see, best case is always there. Okay, I'll quote a rate. Okay, this is the best case scenario. It doesn't work like that. You have to avoid the surprises. Sometimes it's like out of our control, the surprise. But at least lender and the borrower, they have to work as a team and get a best effort estimate, like 2-3 scenarios, the best, optimal, and then whenever appraisal comes back, settle in with whatever works.
Yeah. And we also got another question from Kalyan. Does DSCR applies to refinancing as well?
Yeah, so DSCR can be like you can do a rate and term refinance, you can do a cash out, you can do debt consolidation, any kind of refinances are possible.
Okay.
So
So
sorry.
yeah, go on.
Yeah.
Yeah,
So
you
from
can go
a
ahead.
traditional lender, let's say from a traditional lender, when they finance, they do finance like a portfolio loan also. Does it apply here when we refinance?
Yeah, so you can do a portfolio loan. There are very few lenders who will do a portfolio loan, and also there are see, as I told you, there are so many lenders. They'll all have their own guidelines and overlays. Some will allow only 4 properties. Some will allow 8. Some will allow 10, 20. So it all depends on the lender we work with, and we try to fit the scenario.
Will DSCR apply to homes with land?
No, homes land.
I mean, homes with land that's still in an LLC.
So there is a dwelling.
Yeah, of course. Yeah.
Yeah, there is a dwelling with the acreage up to 20 acres is possible.
Ah, I see. Okay, thanks.
Okay. So let's wrap it up with last question from my
Hi,
side.
sorry. This
Yeah,
is
yeah,
Pavan.
go ahead.
This is Pavan. I actually had multiple meetings at the same time, so I have to join just now in the last 1 minute. What can I do to catch up on this? Is there a recording or is there another session?
Yes, Pawan, we have been posting all of our webinar recordings into our REF app. You can
Okay.
get the link uh, in the WhatsApp group if you are there, or you can just search for reforum.net, reforum.net, and go to the mobile app and download it. We are posting all the webinars recordings there.
Okay. Thank you so much.
Yeah. So yeah, just wrap it up for the last question. After 2 decades in financial markets and mortgage lending, Anusha, what is the one piece of advice you find yourself giving most often to investors who want to scale their portfolio the right way?
Yeah, always I see like when they come with an assumption that it is doable and they end up with all those messier things, they find come up with surprises. One advice is like don't focus too much on interest rate. Just have a what you would say, like a cushion, like 0.25 or 0.375, because markets are going to change. It's always ever changing. No point tracking that day in and day out like a stock market. Always I tell the borrowers, be it a primary home or an investment. In the larger picture, this is nothing. And it's really, you feel after like, doing all this, it's not even worth. Number two is like when they say I'll buy later, markets will come down, markets will go up. All that doesn't work in the long end. In investment space, when you find a good property, identifying that property is the main thing. Okay, then comes the rate, then comes cost of financing. You always have an idea. Cost of financing, any borrower will have an idea. That's when they know that it is affordable. That's when they start searching. So you don't always track these real estate markets every day. You find good treasure. If you are comfortable with it, just buy it. Similarly to primary home also. There is no timing in this market. It's all about finding the right property. This is something I always insist. And wherever I talk or wherever I post in social media, it's always this, not about the risk at all.
Okay, okay. So, Anusha, thank you so much. This has been incredibly valuable. For anyone who wants to connect with Anusha, explore a DSCR scenario, or simply run your numbers, please reach out to her directly. And for more expert speakers, previous webinar recordings, and a community of investors and real estate professionals, join us on the REF app. We will see you next time.
Thank you so much, Vineet, for this opportunity. Thank you, everyone.